Bitcoin has finally made a decisive move higher. So far in 2026, price is up roughly 10%, and we're once again knocking on the door of the $100,000 level. The big question now is whether this marks the start of a sustained breakout, or if it's simply another bear market rally before one final move lower. At the same time, there's an important detail many investors can't ignore. Gold significantly outperformed Bitcoin in 2025, but not for the reasons most people assume. Today, we'll uncover a key insight hidden in gold's rally, one that helps explain why Bitcoin stalled and why that dynamic could shift dramatically in 2026. And then there's fiat currency. Overnight, the Iranian rial collapsed, becoming the latest example in a long line of currencies racing towards zero. It reinforces a conclusion that history keeps repeating. There is no substitute for sound money. This is all about Bitcoin, the show where the noise fades, the facts remain, and the conclusion keeps pointing to Bitcoin. I'm your host, Leo. Let's dive in. Bitcoin started 2026 with real momentum, briefly pushing as high as $98,000 and currently hovering around $95,000 at the time of recording. Community sentiment sits at 81%, and importantly, this move isn't being fueled by reckless leverage. While some short positions were liquidated along the way, the bulk of buying pressure is coming from spot demand, real capital, not borrowed money. Funding rates actually turned negative as price moved higher. That doesn't eliminate risk, but it does signal something different about this rally, which brings us back to a familiar debate, the 4-year cycle. Longtime Bitcoin investors recognize this moment. A sharp recovery after a 30% correction naturally raises skepticism. Is this just another fake out before a deeper drop? Historically, that concern makes sense. Bitcoin has conditioned markets to expect clean 4-year patterns tied to the halving. But markets evolve, and when narratives start to break, it usually happens when price refuses to behave the way everyone expects. That brings us to our first clip. Joe Carlesare recently joined Natalie Brunell on Coin Stories, and he captured the tension around the 4-year cycle debate perfectly.
I'm a big believer in the cycle being dead. I think the cycle has been dead for a while here, even going back to 2022. So the fact that we didn't hit this ultimate peak in the marketplace, that doesn't mean that we can't be higher this year and higher the year after that. I think the cycle theory is dead, and we can get into that. But the other issue, I do think the treasury companies, that took a lot of the wind out of the sail of money. People were thinking, well, it's a bull market. I'm going to go into these treasury companies, which are just leverage plays on Bitcoin. And because of that, that's depriving capital organically of the Bitcoin marketplace. A good thing in the long run, in the short term for Bitcoin price, maybe a little bit of a headwind. And then the final complicating factor, I think, is that you have this notion, I call it sort of a myth of the 4-year cycle, right? And this idea that we have to peak out in October, November of with the year after the halving, right? This is something we're digesting. We're working through it. And I think it's very optimistic because once that dies, once Bitcoin truly is understood by the retail masses as sort of an institutional asset, I think it's going to send us much higher in this year and in the next year. But I'll just tell you anecdotally, because we were talking before camera came on about some of my experience. I play poker with a regular group of guys. They're involved in a lot of different assets. They're in crypto assets and broader, Bitcoin, some Bitcoin exposure, but mostly crypto assets. And what they all told me is they all sold. I was the only guy at the table in this regular game who had still held as of December. We're recording here in January. In December, I was the only guy. Everybody else is the cycle's dead, or the cycle is over, Joe. You got to pack it up because we're going into some big bear market. And what I always respond to them is, if you all thought there was going to be some explosive, high growth Q4, and that didn't come, right? We kind of peaked out really early in Q4. It wasn't really explosive at all. It wasn't bubbly in my estimation. Then why do you expect a big 70, 80% drawdown? And I think that money flows in. I think it's just waiting on the sidelines, waiting to buy back in. The capital hasn't permanently left the space. So it's really exciting. Like, the death of this 4-year cycle theory is going to be massive, particularly when you look at the broader economic picture that is really bullish.
What Joe is really highlighting here isn't that market cycles suddenly stopped mattering. It's that market expectations have shifted. In 2025, we never experienced the classic euphoric blow-off top. There was no final speculative frenzy that needed to be washed out. Capital didn't panic and exit the space for good. Instead, what we saw was far more subdued: rotation, hesitation, and extended stagnation. The money didn't vanish. It moved to the sidelines. And while Bitcoin spent a long period consolidating, that sidelined capital looked for a temporary home elsewhere. That brings us to gold. Gold had a historic run in 2025, and for many Bitcoin investors, watching it outperform was uncomfortable. But gold didn't lead because it suddenly became superior. It led because during periods of rising uncertainty, capital typically flows first to the asset it already understands. Gold is highly liquid and universally recognized. It lives on central bank balance sheets and fits neatly within institutional mandates. So when macro pressure builds, gold often moves first, not because it's better, but because it's familiar. And this is the key insight Joe offers in hindsight. It explains why Bitcoin stalled while gold surged in 2025, and why that divergence is unlikely to last.
The other thing I did think was a headwind for Bitcoin, which is rather unexpected by people this year, is the move in precious metals. I do think that gold getting moving, and it's part of what Luke's talking about. Like if you listen to Luke's podcast about this, Luke Groman's podcast, he's talked about like how, gold's performing very well. Why isn't Bitcoin? Well, there's various different factors in play that the assets are not comparable. I view them very differently as assets. But my point is, when you see a shiny moving object, pun intended, money's going to go there. There are portfolios that literally will fast money that will just chase what's moving. And that has this compounding effect. So if Bitcoin's not moving and gold, which is understood and, it's held by central banks, it's not as quote unquote risky as people perceive Bitcoin is. To me, like that's just explaining. You're taking flows that would go to Bitcoin from retail frenzy, and they're putting them in the gold. So why wouldn't you expect one to underperform?
This is where the story becomes far more compelling when you step back and look at the bigger picture. Gold didn't explode higher overnight. It spent years quietly absorbing demand, building a base beneath the surface before finally breaking out in 2025. And when you view it through that lens, a striking parallel begins to form with Bitcoin today. That's the framework Matt Hogan lays out, one that reframes how we interpret gold's recent performance and, more importantly, what it may be signaling for Bitcoin going forward. Instead of seeing gold's rally as competition, this perspective suggests it could be leading indicator behavior, a reminder of how capital behaves before a larger shift takes place. If that pattern holds, Bitcoin's extended consolidation may not be a weakness at all, but a period of accumulation before the next major move. It's a shift in thinking that changes the entire narrative of where we may be headed next.
I mean, the ETFs are absorbing the selling of OG and traditional investors, and it's just a ratio. The thing I often point people to because of what happened last year is actually gold. Everyone knows that gold had a tremendous year in 2025. It soared to new all-time highs. It ripped. It was the best performing asset in the world. And when people note that, they say, what drove it? It was central bank purchases. But if you actually look at the data, Nate, what you see is central bank purchases ramped after the U.S. seized Russia's assets. And they went from about 400 tons a year to 1,000 tons a year. That's a lot of gold. So in 2023, central banks bought 1,000 tons of gold. The price didn't do much. In 2024, they bought 1,000 tons of gold. The price didn't do much. In 2025, they bought 1,000 tons of gold, and gold went parabolic. And the reason it took 3 years is because of those first 2 years, there were existing holders who were willing to sell. And they were willing to sell, and miners were willing to sell. And then they ran out of gold to sell. But the demand was still there. And when that moment happened, the price went parabolic. So I think what we saw in 2025 is you had institutions playing the role in crypto that central banks did in gold. Persistent buying demand. You mentioned the statistics, buying more than 100% of the supply. And you had some existing people that were willing to sell. And maybe in Q1 or Q2 of this year, they'll continue to be willing to sell. But it's not an infinite supply. At some point, they will run out. And Bitcoin will have the same experience that gold did in 2025, which is I think the price will go parabolic. And to me, it's just a matter of time as long as that institutional demand persists. And I expect it to not only persist, but accelerate because you have all these platform approvals and other things happening.
Gold didn't go parabolic the moment central banks and institutions began buying in size. That demand showed up years before the price reacted. Why? Because there were still plenty of sellers. Gold's market is deep and highly liquid, able to absorb sustained buying pressure for a long time before supply finally tightened. And if that sounds familiar, it should. Bitcoin has been going through a remarkably similar process. Over the past few years, steady institutional and corporate demand has been building through ETFs, treasury allocations, and structured products, while long-term holders have been willing to supply that demand. The result wasn't an explosive rally, but a prolonged period of consolidation throughout 2025. Here's the critical difference. Gold sits in a market worth over $30 trillion. Bitcoin, by comparison, is closer to $2 trillion today. That gap matters. When marginal demand finally overwhelms marginal supply in Bitcoin, the price response won't need years to play out the way it did with gold. In theory, it should take far less time. What unfolded over multiple years for gold could compress into a much shorter window for Bitcoin. Now let's move beyond charts and into the real world, because something far more consequential happened this week. The Iranian rial collapsed again, marking another chapter in a currency that has been deteriorating for decades. Moments like this strip away abstract debates. When a currency fails, the questions become brutally simple. How do you exit? What do you carry? And what actually holds value when borders close and trust disappears? Few people explain this reality better than Vijay Boyapati, author of one of the most influential bullish cases for Bitcoin.
But gold failed because it has this Achilles heel that it's physical. And the physicality of gold creates a few problems, and one is like the centralization of like where people hold their gold, because it's very cumbersome to move gold around. So what happened was gold kind of became centralized in a few banks, and it's difficult to take possession of large amounts of gold. It's scary and it's risky. And where do you put it? Under your mattress? You don't want to hire like a whole army.
Well, is it real? I always think, is it real?
No, exactly. Verifiability, like there's a lot of fake gold. That's another part of the problem, the physicality of gold. Gold as money was the closest thing we've come to an immutable political economic institution in human history. I think Bitcoin gets us there. It gets us to an institution which could be immutable, and that's the radical part about Bitcoin. It's the fact that it's kind of boring money. Yeah, that seems like it's not that important, but the fact that it can't be changed or manipulated and it can't be politicized, that's the radical departure from the past.
Yeah.
There is a certainty to owning Bitcoin that you can't get really anywhere else. And a long time ago, like I referred to this before, when I was a gold bug, I bought some gold coins in like kind of not an online exchange, but like we have Craigslist in America, which is like a service where you can buy and sell things, and you just post an ad saying, "Hey, I'm selling this." And I remember actually how scary it was to go and buy a gold coin, because like you don't know if it's real. And actually the person on the other side who's getting dollars doesn't really know if the dollars are real. Like they could go to a bank and verify it, but it's like inconvenient. Whereas Bitcoin, if you trade something for Bitcoin, you have absolute certainty that you got the Bitcoin. Like you can look at your node and look at the network and see the confirmations. That level of certainty is something that's very unique to Bitcoin.
When you're actually living through a currency collapse, whether in Iran, Venezuela, or anywhere else, the differences between these assets stop being theoretical very quickly. Gold and silver may look appealing on paper, but in the real world, they come with serious limitations. They're heavy, they're visible, and the moment you try to move with them, they attract attention. Bitcoin is fundamentally different. It doesn't sit in a bag. It doesn't need to cross a border with you. Your wealth can exist as information, secured by private keys that can live in your memory. And when money is breaking down around you, that distinction isn't philosophical. It's the difference between having an exit and having none. Once you start viewing Bitcoin this way, not as something you trade, but something you rely on, the question changes. It's no longer when do I buy, but how do I acquire this strategically and hold it responsibly? Because long-term Bitcoin ownership isn't just about price exposure. It's about custody, security, and ultimately legacy. Now zoom out. Bitcoin is back near $100,000. Gold made its move first. Institutional interest is still early, not late. And across the globe, fiat systems continue to show cracks. Short-term price action will do what it always does: shake confidence, test patience, and create noise. But the long-term picture hasn't changed. Bitcoin remains the most portable, verifiable, and incorruptible form of sound money ever created. And I'd argue it's still the most undervalued asset on the planet by a wide margin. That's what gets lost when attention stays glued to the next candle. And regardless of what the chart does next, the conclusion remains the same. There is no second best money. Now I want to hear from you. Has gold already passed the baton to Bitcoin? Or does this consolidation still have more work to do? Drop your thoughts in the comments. If this episode helped clarify the gold versus Bitcoin debate, hit the like button and share it with someone who's still unsure. And don't forget to subscribe to Lights On Invest so you don't miss the next video. Thanks for watching. I'll see you in the next one.